what do you do when a company that's riding a powerful long-term theme confounds Wall Street? That's the question I keep asking myself about Palo Alto Networks, PNW. It's a major player in the cybersecurity space. After rallying hard in October and most of November, Palo Alto reported a solidly better than expected quarter a few weeks ago. Then the company's forecast was widely considered to be tepid, and the stock got pancaked, plummeting from 250 to 220, single session. The problem? Management guided for earnings for $1.11 to $1.13 for next quarter. Wall Street was looking for about $1.30. However, Palo Alto says the numbers were misunderstood, perhaps even by me, and I want to be open-minded. Same day, company announced that it's acquiring Arora. That's a hybrid cloud security play for $150 million, and the cost of the deal is included in those numbers, which means the forecast may not be comparable with the numbers Wall Street was anticipating. I want to hear the other side of the story. So let's take a closer look with Nikesh Arora. He's the chairman and CEO of Palo Alto Networks to get a better sense of where his company's headed. Mr. Arora, welcome back to Mad Money.
Thank you very much, Jim. Thank you for having me.
Okay, so Nikesh, before we get into the nitty-gritty, let's take a step back for a second. You were recruited to join Palo Alto Networks, chairman and CEO, but roughly a year and a half ago. Please give us an overview of Palo Alto then and Palo Alto now.
So, Jim, when I joined Palo Alto Networks 18 months ago, I remember sitting in the same seat and talking about the phenomenal opportunity ahead of us as far as being able to build a cybersecurity platform. I'm delighted to report that what we've done in the last 18 months has even surpassed my expectations. We've taken a company which was a single product company. We did a really great job at building, selling firewalls, and making them part of a data center, to now having built 3 phenomenally good platforms. And as you know, in the enterprise space, every successful large enterprise company is a platform play. You talk about them on your shows. These are companies that have become the fabric of the future enterprises. And what we've done in 18 months is we've built a cloud security platform, we built a SOC automation platform, and we enhanced our enterprise firewall platform. So I couldn't be happier with the progress we've made on the product side. Now the opportunity is to take that product capability we built in 18 months and go out and sell and execute on the go-to-market side in a flawless fashion.
Now, you talk about that one of your conversations on Wall Street, where you have to incent the salespeople to sell the better, higher margin equipment. How is that going?
Well, Jim, I've been studying enterprise companies, and if you look at it, the product gross margins of enterprise companies are pretty similar. The true leverage comes from being able to reduce their cost of sales over the long term. Large successful companies have done that, and that is our opportunity. To do that, you've got to figure out how do you take a sales force and have it be able to sell multiple products in a consistent fashion. So we did that by torquing our incentive systems to get our salespeople who sold firewalls, get them really excited about being able to sell our next generation security products. And I'm excited to report that they actually understand it. They're smart. We paid them a lot of money to go sell next generation stuff, and they did. They sold $194 million of that in Q4. They sold $173 million of that in Q1, which far surpassed our own expectations. When they did that, they didn't sell our firewalls as much because they were busy trying to make money on selling all the good stuff, which is phenomenal because that's the behavior we expected. That's the behavior we incented. Now it's just a simple matter of striking the right balance between us able to sell our core firewalls as well as our next generation stuff. Trust me, they know how to sell firewalls.
Is that why you think maybe Wall Street misinterpreted? I'm talking about the $250 to $220 decline. I think people felt like that you're selling the good stuff, but you're left the other side to not, let's say, didn't make enough money in the other stuff. Is that a correct depiction, or is Wall Street wrong?
I think Wall Street, in true Wall Street fashion, is very focused on very, very short-term outcomes. Right. And you see this every day on the enterprise security business, enterprise companies from a SaaS perspective. Long-term revenue, which is ratable and repeatable, is great. We sold more long-term revenue, which we can book every month, and we sold less short-term revenue, which is what I call instant gratification, which has technical impacts on your P&L. You understand those? We had a $30 million shift. We sold more long-term stuff than short-term stuff. Right. We still meet our number of $897 million. We beat it. So from my perspective, it is nothing systematic. All we saw was our people selling better for what we want to achieve in the long term and having taken the eye off the ball for the short term. I take that trade every day. Of course, I want to do both really well, and we made changes in our incentive system to be able to do that. We have not changed our guidance for the full year or for our 3-year forecast we put out for the analysts. We've actually raised our guidance for our next generation stuff for the year.
All right, so I have said good things about Fortinet and CyberArk. I have followed the path of Zscaler and CrowdStrike. You directly have been taking on Z, and you've been taking on CrowdStrike. Tell me where I may be short-sighted in thinking, say, that Fortinet and CyberArk are the ones to invest in.
Look, I think, Jim, it all depends on your perspective on cybersecurity. When I came to Palo Alto Networks, the first thing I was faced with was, hey, firewalls are dead. You know what? Firewalls are not dead. There's more traffic in the world, more traffic that needs to be inspected. You're going to inspect it either with a box or a software form factor or a cloud-delivered firewall. Guess what? One company in the universe that has all three products is Palo Alto Networks. We can give you a cloud-delivered firewall. We can give you a virtual firewall. We can give you a box. You have to go buy it from Fortinet, Zscaler, and probably somebody else. So we have all the products that are needed. 18 months ago, we didn't have a competitive product enough with Zscaler. Today, we see them head-to-head in many deals. We didn't have a competitive product against CrowdStrike 6 months ago. Today, we see them head-to-head in many deals. We've gone from being able to have one product in the top right quadrant of Gartner to having potentially 5 products competing with some of the most innovative, forward-leaning cybersecurity startups. So from that perspective, I think we're just getting started.
All right, one last question. You have schooled me into knowing that it's a $140 billion industry. You only have 2.5 to 3% market share. Maybe I'm wrong to even think about the idea that there's a couple of companies and there's a big battle royale amongst you.
We're not a consumer internet business. Internet plays with this, winner takes all and everybody else has to wait. I just want to go from 2.5% to 10%. I'll have a phenomenally great business. We're already the single largest pure play cybersecurity company in the world. And all we need to do is keep building on that strength, keep building on the strength of the 5 product categories we built, keep executing flawlessly and creating leverage from our teams and sales forces to be a large cybersecurity player.
Excellent. I am so glad you came on. It is great to hear from you. That's Nikesh Arora, the CEO of Chairman of Palo Alto Networks. Now I think you understand that perhaps that decline may have been mistaken. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.